You wake up richer than yesterday. At least, that's what the headlines say. The economy grew. GDP is up. Markets are strong. Productivity hit a new high. On paper, the country is doing better than ever. But you feel poorer. Rent takes a bigger bite. Groceries feel lighter for the same price. Saving feels harder. Getting ahead feels slower. Like running on a treadmill that keeps speeding up. This isn't in your head. Economic growth can make you poorer, and not by accident. That sounds wrong because we're taught one simple story. Growth is good. Growth means progress. Growth means opportunity. When the economy grows, everyone wins. That story is incomplete, and the missing parts explain a lot of modern frustration. Let's start with a basic question most people never ask. What does economic growth actually measure? Economic growth usually means GDP growth, gross domestic product, the total value of goods and services produced in a country. If GDP goes up 5%, the economy grew. But GDP doesn't ask who got the money. It doesn't ask how that value was created, and it definitely doesn't ask whether your life got easier. If a company automates 1,000 jobs and boosts profits, GDP goes up. If housing prices double because of speculation, GDP goes up. If healthcare costs explode, GDP goes up. Growth doesn't mean improvement, it means activity. Now, here's where things get uncomfortable. Modern growth is often disconnected from wages. For most of the 20th century, productivity and wages rose together. Workers produced more, and they earned more. The system wasn't perfect, but the link existed. That link broke. In many advanced economies, productivity kept climbing while real wages flattened. The economy got richer, workers didn't. Where did the extra money go? Up. To asset owners, to shareholders, to those who already had capital. Growth didn't disappear, it changed direction. Imagine the economy as a rising tide, but only some boats are allowed to float. Everyone else is standing in the water. Now, let's add another layer most people miss. Modern growth is heavily debt-driven. Governments borrow to stimulate growth. Companies borrow to expand. Consumers borrow to maintain living standards. Debt pulls future money into the present. It makes growth look stronger today by borrowing from tomorrow. That works until it doesn't. When growth depends on debt, someone has to service that debt. Interest payments don't come from nowhere. They come from income, from taxes, from wages, from prices. If you don't own the assets that benefit from growth debt-fueled, you're likely paying for it. This is how growth can quietly become a tax on the future. Now, let's talk about inflation, not the headline kind, the subtle kind. When economies grow through monetary expansion, more money, more credit, the effects don't hit everyone equally. New money enters the system at specific points: banks, financial markets, large institutions. Those closest to the source spend first. They buy assets before prices rise. By the time the money reaches wages, prices have already adjusted. This isn't a conspiracy, it's a mechanism. It means growth can raise asset prices faster than incomes. Housing, stocks, education, healthcare. If you don't already own those assets, growth prices you out of them. So yes, the economy grows, but the ladder gets taller while you're standing still. Here's the irony. Growth is often sold as a solution to inequality. In practice, it can amplify it, because growth rewards position, not effort. If you own capital, growth multiplies your wealth. If you sell labor, growth only helps if bargaining power exists. In a globalized economy with automation and weak labor leverage, that power shrinks. Now, let's zoom out. Why does this matter right now? Because governments, markets, and media are obsessed with growth numbers. Growth is the scorecard. Growth justifies policy. Growth calms voters. If growth is positive, the system claims success, even if daily life feels worse. This creates a disconnect between official reality and lived reality. People aren't rejecting economics because they're irrational. They're reacting to a system that tells them they're winning while they're struggling. That gap breeds anger, populism, distrust, and it keeps growing. There's another uncomfortable truth here. Some growth is defensive. When costs rise because of monopolies, inefficiency, or financialization, spending increases just to maintain the same standard of living. GDP goes up, quality of life doesn't. Think of healthcare bills, housing costs, education debt. If you pay more to get the same thing, the economy grows. You don't. Now, let's talk about time. Growth compresses time. It rewards speed, short-term returns, quarterly results. Long-term stability gets sacrificed for near-term expansion. Companies cut durability to boost margins. Governments underinvest in resilience to protect growth numbers. The economy looks stronger right up until it isn't. Then the bill arrives. Crises often follow periods of strong growth, not despite them, because of them. Growth masks fragility, it hides leverage, it makes risk feel manageable, until reality interrupts. At that point, losses are socialized, bailouts, inflation, austerity. Growth was private, the pain is public. Now ask yourself something uncomfortable. If growth can make large parts of the population poorer, why is it still the primary goal? Because growth is measurable, distribution is political. It's easier to chase a number than to ask who benefits. And growth buys time, it delays hard decisions. But delay isn't resolution. Eventually, a system that grows while making people feel poorer faces a legitimacy problem. That's where many economies are now. High GDP, high asset prices, low trust, high anxiety. The numbers say success, people feel failure. So here's the real question. Is the problem that growth is bad, or that we built a system where growth no longer means shared progress? Because if growth continues in its current form, concentrated, leveraged, asset-driven, it will keep making many people poorer in relative and absolute terms. And if growth slows, the debt and expectations built on it become dangerous. That's the trap. Growth makes you poorer. No growth makes everything fragile. So what comes next? A different definition of success? New rules around money and assets? Or a system that keeps chasing growth until the gap becomes impossible to ignore? The economy will keep growing. The real question is whether your life will.